With the market trending downwards with no end in sight right now, a common question you may be asking yourself at this moment is, when is the bottom of the Toronto real estate market? When will prices stop falling? And when is the best time for you to get back into the market, whether you're buying or selling, and to start transacting again? These are actually all very common questions I'm getting asked right now when speaking to people, whether it's clients or potential clients, about what's happening in the real estate market, or something along the same lines of that, right? So if you find yourself sitting on the fence or sitting on some capital, some money, whether it's for buying your first home, your move-up property, that's from going to a condo to a freehold, or even maybe like your next investment property, you're probably wondering what the answer to this question is, right? I know I am. So stick around to hear what savvy real estate investors are doing and my professional advice on what to do during these really highly unpredictable times. And if you do find yourself in a sticky situation or something that you're confused about, because everything is kind of weird and unknown right now, and you want to discuss what options you have, then you can book a strategy call with me using the link on the screen right here. It's www.chatwithzen.com, and you can just simply follow the steps and we'll be chatting in no time. Simply click on a date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name's Zen, and I run a RE/MAX brokerage in the Greater Toronto Area, in addition to making some awesome educational real estate content for you that you're watching right now. Now, how do we as real estate professionals know, when the bottom is, right? And everyone's looking for that magic answer, the secret sauce, right? And here's the truth. We don't. Nobody does, regardless of how many crystal ball jokes I make on YouTube right now. And I've been right on a lot of predictions, and I've also been wrong before, but I always approach these predictions really from a data perspective, numbers perspective, and kind of like a underlying what kind of sentiment I'm sensing when talking to other clients and colleagues of mine, right? That's how I arrive at these predictions. Now, the real question you should be asking yourself, instead of when is the bottom, is when are prices going to stop falling, right? Because nobody wants to buy a property today knowing that their property could be worth less in a few weeks, in a few months, in a year's time. Nobody wants that feeling. That's exactly what you're probably after by reading the headline of this video. So how do I look for that? Well, the easy answer is I look at the months of inventory. This is a metric you've seen me talk about countless times. Months of inventory is essentially, from a mathematical, nerdy, technical way, it's the number of active listings divided by the number of sales at the end of the month, or whatever time period you're trying to measure. And if the months of inventory is increasing, meaning that we're getting more properties than price, like to sell or buy, I guess depending on how you look at it, and prices should be decreasing. Now, if the months of inventory is coming down and we're getting less inventory, meaning less stuff to sell, or sales, like the activity, the transactions are picking up, we should see prices go up. Now, we've been seeing our months of inventory increase for the last 4 months, so we should continue going down that trend, meaning prices are coming down. And if you ask me, based on all the data that I see and all the economics I study, where I think we'll see the first sign of the months of inventory staying the same and not increasing, I think it'll be about September at the earliest. Now, without boring you to death, here are my 3 main reasons why I think September is the month to look at. Reason number 1, summer should be slow. It's the first summer since the pandemic, like 2 years ago, where we're able to run around without a mask. So I think people are going to go and enjoy it. Second, we're getting on the rate hike in July on the 13th, but we're going to get a break on rate hikes in August because, even the Bank of Canada takes a break until September 7th. So we'll have a break between markets and we'll see where it settles. Third, inflation increases are having a base effect of comparing increasing CPI prints to last year, where CPI prints are high. And what that basically means is we're comparing a high year over year, right? So inflation will either roll over by the summer, or we'll see disinflation, or we'll see continuous inflation growth, which is absolutely ridiculous by my metric, because it's 7 to 8% year over year. And, it'll continue to the end of summer and it'll be really, really bad, right? So that's how I'm looking at it. If you found this content useful, it probably also means other people will find it useful. So make sure you help me smash that like button to share this video with others. And while you're at it, make sure you subscribe to the Prime Prop Zero channel, because I know a lot of you who are watching are not subscribed, because I'm a nerd like that and I see the analytics, right? So if you want to enjoy more awesome content like this, just subscribe and you'll know when I put it out. Now, I know a few of you left me comments on how to determine whether it's a good time to buy last week in the comment section. As an investor right now. So, I'll get nerdy with you on one of my many methodologies I use to determine whether it's a good time to be buying right now. And I'm sharing the secret sauce with you because I know a lot of my investors out there, and myself included, are looking for deals right now to deploy some capital if we can find them. And we're trying to see if the deal we're looking at, the price reduction, makes enough sense to buy right now, despite the market conditions and the constant trend line of going downwards, like I was saying earlier. So let me share my screen and explain to you. Okay, so I created a little quick PowerPoint slide so you would understand, just because I think visually it makes more sense when I explain this, because it gets a little bit technical, because we're going to be talking terminology and things that we normally talk about in commercial real estate, which I have a big background in, and we're trying to apply this to residential investment, right? So you're going to take this a very over the top, overly analytical approach, which is generally how I approach things, to something that you don't need to, but it provides you a little bit more insight, right? So that's why I'm putting this video together for you. So the thing that I need to educate you on is what a cap rate is, right? So cap rate is short form for capitalization rate, and how that's calculated, it's what your net operating income is divided by the asset value, right? And your net operating income is essentially all the rent you'll be collecting after you pay taxes, insurance, and all the inevitable things that you have to put in a bit. And when it comes to a cap rate, right, the higher the percentage, the better it is, right? So we only hear terms like cap rate compression, meaning that the cap rates, the percentages are getting smaller and smaller because the yields are the same, but then people are valuing this asset more and more, so they're driving the prices up. Therefore, the cap rate comes down. And the percentage is important because the percentage means how many years it'll take for that asset to make that money back for you. Because in commercial real estate, when we calculate capitalization rate, we're not financing anything. We're using the assumption that we're going to be buying this thing 100% cash. So how you basically calculate that is you take the years for the repayment, and you get that answer when you take 1 divided by the capitalization rate, right? So if your cap rate is 5%, 1 divided by 5% is 20 years. So therefore, the money that you're generating, meaning the income, right, the net operating income, doesn't count mortgage pay down because you're not financing it, and we don't count appreciation because we're looking at strictly yields, and that's how much you're looking at to return your money, right? A good analogous to this is if you're an equity investor, this is like dividends, right? So if your stock pays you 5% dividends, it'll take you 20 years for that stock to buy itself back based on the purchase price you bought it from. This is the exact same way of calculating it. So what I did is I kind of broke down some of the numbers to show you what we're looking at previously compared to kind of like what we're looking at now, right? So you can see over here that I'm comparing some duplexes that we bought in the suburban areas. And you can see in 2020, right, early start of 2020 before the pandemic kind of hit us. So we're buying these legal properties for $750. Taxes are consistent across the board, right? We're financing this at 20%, and it was at like this was after pandemic, it was like 1.25. So your operating costs would be taxes, any condo fees if you have any, property insurance, and then the rental water heater if there was any, right? So these are things you can't avoid. Now you can obviously put in your property management fees or whatever, that's up to you. And for us at the moment, right, after all of this, our monthly cash flow is $1,300, which is what you're familiar with because that includes the financing cost, right? So if you've seen me do this, we've done those numbers before, right? So this is how much cash flow you're getting a year, this is how much the mortgage is being paid down, and you factor in appreciation. And this is normally how we look at it. And if you want to get a little bit more technical, we look at cash on cash return, which is about 10%, which was like laughing because from a financing perspective, a cash on cash return is how much money you'll be earning on that. So you're getting repaid in 10 years, which is faster. But what we want to do is we look at the actual capitalization rate, right? So your capitalization rate is your annual net operating income. So that means all your annual rents that you will be collecting, which would be $3,900 times 12 minus $525 times 12. And arrives at 5.4%, which puts you around being paid back in 20 years, which is actually a really good cap rate because in Toronto, the cap rates are 2 or 3%. So then what we want to do is you want to look at the borrowing rate, which was 1.25 variable at the time, right? So you put that in, And there's this thing called the risk premium. And the risk premium, you basically arrive at 5.4 minus the borrowing rate, and you get your 4.15%. And the risk premium is basically the premium that you're getting paid as a return on your money based on where the rates are at the cap rate you're buying from. So the higher the risk premium, the better your returns are. So in post-pandemic 2020, when the rates came down, the risk premium became really, really high. And we generally try to strive for 2 to 3%. And that's what we call the spread in between how much money you're actually making and how much money you're borrowing. And that's a metric I like using, right? So if I'm seeing somewhere between like 3%, I'm like, okay, you know what? This makes a lot of sense because we're putting some money as a risk to get higher returns back. And knowing that the property cash flows and that pays for itself, I'm like, you know what? This probably makes a lot of sense. Now, obviously, in hindsight, you could have locked in the variable rate at, say, 1.75 at the time, and you lock in your risk premium. But if you want variable, then your risk premium will decrease as the variable comes down, right? So now we moved into 2021, where prices went up. We're at 900,000. Interest rates came up a little bit, just call it that. It put our cap rate at still 5.3%. Because what happened is while the price went up, right, on the purchase on the asset, what happened is the rent also went up. So we went from 3,900 rent to 4,500 rent. And this was when the summertime, when the rents went up in the suburban area because everyone was trying to get more space and rent, right? So at the end of the day, yes, the asset got more expensive, but the cap rate stayed the same. Now, the thing is the the borrowing rate came down. Sorry, the borrowing rate went up a little bit. So therefore our risk premium went down a little bit. And again, 3.55%, still pretty comfortable with it. So now we're looking at 2022, right? So say you're buying this thing for $1 million, and then the interest rates where they are right now is at 2.75%. So when you look at all this, the rents haven't really moved. Your cap rate has been shrunk down to 4.77%. But then your borrowing rate is 2 3/4. So therefore now your your risk premium is 2%, which is on the lower side, which is why it may not make sense right now to borrow. So how you'll know whether this makes sense for you as an investor is if your cap rate is really high, despite what the borrowing rate that you're getting right now, and your risk premium is around 3%, you're good, right? So if you were to do an apartment and you can get secured CMHC lower rate, then you're good. Or some people are able to port over the mortgage from previously, then you're also good because then you lock in the borrowing rate. The alternative is you can increase the rents or you drop the asset price down so you can increase your capitalization rate, and that's how you make the numbers work. So this is where we're getting very nerdy and technical, and a savvy investor would understand how to actually calculate a lot of these things to make sure that the numbers still work. Now, these are the examples I was telling you about, right? So you can either have the property come down in price at the current duplex, right, by 100 grand, and you bring the cap rate to 5.3, and you put your risk premium at 2.5%, which some of my clients have done, then you're great, right? If you have a further risk price reduction, and this is what some of my clients just bought recently, then you're looking at 5.6 cap rate, and your risk premium is still 2.88%. Now, obviously, it's not going to be as good as in 2020 when the rates just dropped by so much. But now we're getting up close to where 2021 was, and now you're basically effectively buying at a risk premium that's equivalent to where it was in 2021, even though prices haven't dropped down there, right? And that's just methodology and how I calculate things. Now, for those of you who are looking in the condo space, and you'll understand why I haven't been super pro condo for a very long time, unless it's for personal use, whether you're moving in or you want to buy this for your kids, right? Then yeah, let's go through the numbers and you'll see exactly why. So you're buying a condo for 700 grand, right? Your current rate on that is 2 3/4. You're only getting rent of 2,200. So at the end of the day, right now, you're at 2.81 cap rate. So what that means is you basically need effectively about 40 years or so for this asset to pay you back based on the rents you're collecting. And the problem with condos and why this cap rate is so low is because of the condo fees, right? It's an operating expense that you can't get rid of and it only increases. And then when you subtract that by the interest rate right now, you're getting a 0.06% risk premium, which means there's nothing inherently built in there for you. And that's why I've been saying it's a return-free risk that you're taking right now because, if you look at it from this perspective, you're minus $650 of cash flow. And if you're not getting much mortgage pay down because the rates are high, right, then you're only banking on appreciation. So sometimes it doesn't make sense for the condo right now. And this is why I'm personally seeing a lot of inventory build up. And if we put the condos back into 2021 time, right, where it drops our interest rate from what we have 2 3/4 right now to 1 1/4, right, then you're looking at minus $225, which is, plausible. You can do it if you have other properties to sustain it or you have a high income to sustain it. But then your cap rate doesn't really change too much. But what happens is your risk premium goes up, right? Now you're nowhere near what I would prefer, kind of like 3%, but it's still much better than what you're getting right now, 0.6%, right? And that's kind of one of the methodologies I look at to kind of look at the spread between interest rates, the rents you're getting, and the purchase price paying. And that's kind of like a combination of cap rates, the risk premium, and also just like the borrowing rates and what kind of financing you're able to secure. So that's mixing the commercial side of my head with the residential side and just distilling it down for you guys to try to understand. Now, this is obviously a little bit too complicated. That's perfectly fine. I generally don't go through these calculations with clients unless they're like really, really advanced and they understand some of this stuff. But this is just me kind of shedding some light because you guys want to know about how I'm looking at some of these numbers on whether I should actually be buying this, right? And yes, I'm a giant nerd. You don't need to understand all of this, but this is how I kind of map out, when I'm timing the bottom, because I'm looking at different metrics and different analytics. So that's not just one kind of metric to look at. But having said all of this, months of inventory is probably the best indicator you should follow, so without getting overly nerdy in this. And if none of this makes any sense for you, but you are interested in like, hey, Zen sounds kind of smart. Maybe I should hire him to buy my next investment property, and you want me to run numbers like this for you, you can book a strategy call with me using the link on the screen. It's www.chatwithzen.com. Until next time, your move, your future. See ya.
Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.